So the most important measure that we use in the management of interest rates risk, it's called duration. It's the duration of a portfolio involving interest rates, the duration of a coupon bond, the duration of a zero coupon bond. This is the fundamental measure. And it represents the sensitivity of our portfolio to changes in the yield. Now, the duration is defined in this way. It's 1 over S, where S is the market price of the portfolio, times the variation, delta S, of the price over the variation, delta Y, of the yield. If I assume the variation of the yield to be very, very small, so to be infinitesimal, what do I have? I have that the duration is equal to minus 1 over S ds dy. Now, in economic terms, you can, if you studied economics or you're a little bit familiar with economics, you can recognize in the duration some sort of elasticity. It's an elasticity measure. But what is important to us is to recognize that actually duration is that function I was speaking about last time that involves the rho. And where is rho? Here. You see that duration is minus 1 over S, the sensitivity of the asset we are considering with respect to the yield. And the yield is the interest rate. Okay? So ds dy is nothing more than rho. But when we play with interest rates, we tend not to use rho alone, but as one of the components of duration. Why? Because rho would be an interesting sensitivity of the price of the portfolio, or the value of the portfolio, or of the asset with respect to interest rates. True, but if it is used within the duration definition, it gathers a better insight in terms of interpretation of the different quantities. That's the simple reason. Now, imagine that I have a bond that generates cash flows, that is to say, a bond that pays coupons C1, Cn at different time maturities, T1, Tn. Okay? I know that the yield y can be computed by taking that implicit rate that allows me to discount all the cash flows and make them equal to the market price of the bond. And we have this formula, which is nothing more than the condensed mathematical writing of all the discounting of the different coupons. You remember we had the example in which we had 2.5 discounted plus 3.5 discounted until the last payment that was 102.5. This is exactly the case. So C1 up to Cn minus 1 would be 2.5, and then the last one would be 102.5, just like that. And we discount by the corresponding maturity when we apply the yield. Now, the duration, if we want to compute the duration as minus 1 over S ds dy, is just a matter of computing derivatives. So if you are familiar with derivatives, it's a nice exercise and a trivial exercise to do that. Otherwise, trust me that if you perform that by taking the derivative with respect to y, this t comes down. It simplifies with the minus of minus 1 over s. S is here, and this is what you get. This is your expression if you collect all the terms and you use the additivity in the derivatives. This is the formula for duration. Now, this formula is very important because it can be interpreted in a very relevant way. If you look at this formula, you agree with me that these discounted cash flows when summed together, they sum to S. Okay? So if I take each one of them over S, it's just a quantity that will lie between 0 and 1. I can take it as a weight. And I can use this weight to weight what? The maturities, the T's. So duration can be seen as a weighted average of the maturities of the times at which I receive money from my investment. Or if I'm writing the investment, the times at which I will pay money. Because obviously, if I buy a bond, I receive money. But if I'm a company that issues a bond, I'm paying money. Okay? So the duration is the weighted average of the maturities, where the weights are nothing more than the discounted payments over the market price of the investment of the portfolio, whatever you want. So in a sense, and that's why we use rho within duration and not alone, duration answers a very important question if you are an investor. And it's the question, how long I have on average to wait in order to see money, in order to see a cash flow coming from that investment. Or how long I have to wait, if I'm the issuer, before I pay over the investment. Very important, from this formula, we immediately derive a fundamental difference between a zero coupon bond and a coupon bond. So what's the difference between a zero coupon bond and a coupon bond? It's trivially the fact that the coupon bond pays a coupon. Okay? And if it pays the coupon within the time framework. So if today is 0 and our investment is over 1 year, in a zero coupon bond, I will get my interest and capital in 1 year. If it is a coupon bond, I will get also some coupon in between, every month, every 2 months, every 3 months, I don't know. So you can imagine that what would be the duration of a coupon bond? It will be the weighted average of all the cash flows. And cash flows happen within 1 year. What is the duration of a zero coupon bond, conversely? It is the weighted average of all the cash flows, but all the cash flows are just generated at maturity. There is nothing in between. So for a zero coupon bond, duration is equal to the maturity of the zero coupon bond. If I invest over 1 year, I will get my money in 1 year from now. And if I issue a bond, which is a zero coupon bond, I will pay in 1 year from now. Okay? So that's very important. In a zero coupon bond, duration is exactly the duration, so the time length of the investment. In a coupon bond, duration is by definition strictly smaller than the maturity of the investment. It can be smaller but still close to maturity if the coupons are small, and then obviously the weight of each coupon on the total is irrelevant, and the last big payment will prevail. But if there are very large coupons, duration can be sensibly smaller than the time horizon of the investment. Okay? So that's very important for different reasons. Because if you want to make an investment in a bond and you open your Finanzielle Dagblad or whatever you want, what do you have? You read there and you know immediately, on average, you can easily compute, okay, what is the time that you have to wait in order to see your money? Obviously, this time is weighted by the coupons because money has a cost, and you want to know actually how these times are weighted by the cost of money. That's why you use the coupons. But you also know immediately that if you invest in a zero coupon bond, duration is the maturity of the zero coupon bond. You don't have to waste your time in doing these computations. And this quick information, it's something very sensible on the market. And also during the exam, because it's totally stupid to waste your 10 minutes computing the duration of something that you know is equal to maturity. Okay, so you know it's a zero coupon bond. What's the maturity? 3 years, because it's a 3-year zero coupon bond. What's duration? Yes, 3. Okay, very simple. So let's consider this exercise. So we have a 3-year coupon bond, so it pays a coupon with a face value of 100 euros. The continuous compounding yield is 12% per annum, and there is a 5% coupon that is paid every 6 months. So every 6 months I get 5 euros. What's the duration of this investment? Now, already before starting your computations, from this very simple exercise, you know that this is a 3-year coupon bond. There are intermediate payments, so duration cannot be 3. It will be smaller than 3. Okay? That's the first thing. Is it 2? Is it 2.5? Is it 2.99? That we don't know. We have to compute it. But for sure, it is not 3. Why? Because there are intermediate payments. Now, what we want to do is to compute duration. Now, to do that, we have to apply the formulas that we have seen before. So this is the formula. Now, in this formula, we need the coupons, and we have that information. We need the yield, and we have that information. We need the maturities. We know every 6 months I have a payment. But we also need S, and S is the market value of the coupon. So the market value of the coupon for us is something that is not given by the text of the problem, so it needs to be computed. Now, look at that formula. So that formula tells me that I have to take the sum for I from 1 to n of what? Of the coupons, CI discounted at the yield rate times TI, the corresponding maturity. Now, for us, what does it mean? It means the following. Let's go back here. So we have a 3 years coupon bond, and we get 5 euros every 6 months until the very last moment in which we also get our capital back, the face value back. So 100 euros. So what do? We simply have to apply this formula. So the first coupon, C1, is what? It's what we get 6 months from now. So it's 5. We just get 5. So 5 times what? The exponential of minus what? The yield, which is there, 0.12, times the time horizon, 6 months. As I told you, the convention is to use fraction of the year. So 6 months is 0.5. So times 0.5 plus, again, 5 in 1 year from now. So it's minus 0.12 times 1 plus 5 e to the minus 0.12 times 1.5 plus, I go on, I reach e to the minus 0.12 times 2.5. Obviously here I will have also the I can write it there. I mean, it's not a big advantage. I'm lazy, but not at this point. 2.5 plus, and that's very important, at the last moment, 3 years from now, I will get 5, but also 100. Okay, so the last one will be 105 e to the minus 0.12 times 3. Okay? If I solve this, I already did for you, the result is 94,213. But it's a nice exercise to check if my computations are correct. Most of the time I do my computations on the train, and it's not the best situation, so always double check my computations. But it makes sense. That's the price. So imagine that I solve this trick for the exam, and I get that the result is 102. Can it be? No, because I will get a price which is higher than the face value. Okay, so the price that I will get if I have positive interest needs to be lower. Okay, in negative interest rates actually it could be, but never happens for a bond, at least for the moment. So this is the price, 94. Now what I want to compute is duration. Again, check again the formula. The formula is this one. So if I want to compute duration, what do I have to do? I will have to apply the formula. I will not copy the formula, so it's just there. But what I have to do is to take the weighted average of the maturities. Now, what's the first maturity? The first maturity is 0.5, 6 months, times what? The corresponding weight. And the corresponding weight is given by the discounted 6 months coupon over the price of the market price of the bond. So the first is this guy here. So it's 5e to the minus 0.12 times 0.5 divided by 94,213 plus 1, the second maturity, that multiplies what? Here, 94,213 remains the same, and at the numerator, I will now have these. So it's 5e to the minus 0.12 times 1. And I will do that for all the maturities until I reach 3, the last maturity, that multiplies 94.213, and at the numerator, this guy here, 105 e to the minus 0.12 times 3. Okay? If I perform this computation here, the duration I get is 2.65. And you see that 2.65 is smaller than 3. That will be the duration of a 3-year zero coupon bond. So this investment, if I compute the duration, tells me that considering the coupons and considering the value of money as represented, for example, by the interest rate and blah, 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 on average, I have to wait 2.65 years. In reality, I will see the first payment after 6 months. True, but this is a weighted average of the waiting times of the different maturities for the different coupons. And since the last payment is the biggest one, the average is pushed towards or attracted by the last payment. If you increase, for example, the coupon from 5 to say 10, it will be a totally incredible investment that you will never find. But if you do that as an exercise, if you increase the coupon to 10, you will see that duration will slightly decrease, and so on. Okay? Clear? It's just boring, but not particularly complicated. So let's continue with the same framework, okay? And let's consider a second exercise. So we are still there. This is the duration that we have computed and blah, blah, blah. And now we ask ourselves, what happens if there is an increase in the yield of 10 BPS, basis points? Basis points are a common way of playing with interest rates. Why? Because typically the movements we see in interest rates are very, very small. And instead of saying there is a change of 0.1%, you say there is a change of 10 basis points. But it's just a matter of convention of the unit that you use. The spread over bonds, the credit spreads that you have in CDS, so all things that we will see are typically described in terms of basis points. Okay, 10 basis points, 50 basis points, 150 basis points, and so on. So let's assume that there is an increase of 10 basis points that corresponds to an increase of 0.1%. So this means that my yield from Y will become a new Y star, which is 1 plus Y plus 0.001, okay? Or the variation in Y is just 0.001. Is there a way of quickly computing how the value of the bond changes? You can use duration. You can use duration as essentially quite nice in this setting. Why? So the formula of duration tells me that duration is equal to 1 over S, with a minus sign in front, ds dy, okay? So I can always rearrange the terms so that the variation in S, the variation in the price of the bond, or the variation in the portfolio, if this is a portfolio, and then we will say delta P instead of delta S, is equal to minus D, the value of the asset S, times the variation in the yield, delta Y. So if I do that, I already have all these quantities because I know that the duration is 2.653 minus times the value of my bond times the variation. If I do that, I know that I can expect a change in the value of the bond of minus 0.25. That means that the new market value of the bond would be the old one minus 0.25. So the new value would be 93.96. Is this value correct? There is a simple way to double check. That is to say, to recompute these, what we did before, so to recompute the present value, but instead of using 0.12, now we use 0.121, the small change that we are assuming for the yield. If you do that, you exactly guess that's the same result. So you can think of rho and hence of duration as a sort of delta for interest rate related products. Why? Because since we know that the price of our asset depends on interest rates, and we take the derivative with respect to the interest rates, what we are doing, we are just building a linear approximation in the interest rate, which is exactly what we were doing last time with delta. In delta, we were taking the linear approximation by playing with the prices. This is another framework, but it's exactly the same idea. So when you use the so-called duration approximation, that is what we are doing here, we are trying to give a linear approximation to the change in the portfolio just by looking at the first order derivative with respect to the interest rate. Now, as for prices, when we were discussing about the problem induced by convexity and concavity, that is to say, to the fact that if we delta hedge, but our product is non-linear, there is a good chance that for large changes in the prices, there is the delta hedge error. We have the same problem here. We can have two bonds that have the same duration in a vicinity of a point, say at the starting point at time 0, but then they have a different convexity. So if we use the duration approximation, we treat them as if they were the same, while they have different behaviors. So in order to deal with the convexity with respect to interest rates, we can introduce a measure that plays the role of gamma. This measure in interest rates is called simply convexity. So convexity is a quantity that, as duration, is not directly the derivative, but it's a quantity that includes the derivative. In the case of convexity, the second derivative. If you do that, convexity is defined as 1 over s. Notice that here there is not the minus sign. It's 1 over s, the secondary partial derivative with respect to the interest rates, with respect to the yield. Again, if you solve the derivative, this is the formula that you get. Okay? In this situation, convexity is no longer a weighted average, but it's still linked, if you want, to the second moment, but the interpretation is a little bit more subtle, so we just skip it. So it's a measure of the dispersion in your model with respect to interest rates. As we did with the other Greeks, for example, with the delta approximation, the delta gamma approximation, the delta gamma vig approximation, we can do the same with interest rates related products. So we can see how the change of the value of the asset is related to duration and convexity. And if you want, we can say that the percentage change in the value of the asset is essentially this very simple, straight formula that includes duration and convexity. Now, is it useful to use convexity? Yes, no, it depends. If the change in the yield is very small, as with delta, the linear approximation works. So the duration approximation is more than sufficient. In our example before, we had a yield of 12% and a change of 10 basis points. But if the change in the yield is bigger, as if the change in the prices were bigger when we were using gamma, then we have to introduce convexity. And we can see that with a simple example. So consider the same bond with the same data. If, and it's an exercise that I suggest, you compute convexity, the convexity that you will get for that bond is 7.57. Okay? That's what you get by applying the formula very simply and computing the quantities. Now, instead of a change of 10 basis points, so 0.1%, we think of a change of 2%. The change of 2% in interest rates is something extremely big. Okay, it's something that is not very common to be observed on the market. It's quite extreme. Okay, so we agree that 2% is not just 10 basis points. It is not a small variation, it's a large variation in the interest rates. So our yield would move from 12 to 14%. Now let's see what happens if we use the duration approximation or we also introduce convexity. If we use the duration approximation, what we have to do is just to apply the duration formula. So the change in my market value would be the old one minus the old one times the duration times the change 2%. The difference would be minus 4.99 in the bond price. If I introduce convexity, I get a better approximation. And I discover that the change is not minus 4.99, but it's minus 4.85. Now, you may think, Who cares? Minus 4.99, minus 0.85. They are close enough. Yeah. The point is that if you then recompute everything, so instead of using the yield of 12, you compute the yield of 14, you find that the actual value is this. And you agree with me that this quantity here that you get with convexity is definitely closer than the one that you get with duration only. And if that quantity is maybe multiplied by a few millions, well, it's an important difference. Okay? It's definitely important for your portfolio. Now, what you can do is to relatively easily, generalize what we have done so far. Typically, as I was telling you at the very beginning of the class, we represent interest rates in terms of a yield curve because we may have the different maturities and we may have the different zero rates. Now, a quite common assumption that is made if you're a bank, we will see later on that banks are, for example, assumed to perform a sort of exercise that is called stress testing. That is to say, they have to make all computations of the different risk measures we will see together, and they have to stress those risk measures by making assumptions like what happens if on the market the interest rate goes up by 1%, or it goes down by 3%. What happens if there is a liquidity problem and nobody is giving me money? What happens if there is a crisis on the market? And they have to make simulations to understand what the possible scenarios are and to try to build strategies in order to cover those scenarios. One of the stress tests that is commonly performed is to assume shocks on interest rates. Now, there are many types of shocks that can be assumed. The simplest one is just to assume that there is a shift in the yield curve. So the yield curve was this one, the bold line, and now it's the dashed one. So it is moved up by some quantity or moved down, but it's a parallel shift. The entire curve is shifted. In reality, we can have more complicated situations because I can say, okay, this is my curve, and instead of this, I now consider this. So there is only a shift, for example, for one of the maturities, not all the maturities. But this is mathematically more complicated, so we ignore it there. We just consider parallel shifts. Now, imagine now that instead of just one asset, we have a portfolio, okay? And the value of the portfolio is P. The portfolio is made of assets that have different maturities. I will have, for example, a zero coupon bond over 6 months, a coupon bond over 3 years, a zero coupon bond over 3 years, and so on. So I have a portfolio that is made of different assets. These assets will have their own interest rates, and all interest rates are represented by my yield curve. And now I make myself the question, I ask myself the question, what happens if there is a shift? Now, if I consider the duration of the portfolio, by simply applying the definition of duration, it's minus 1 over P instead of S. S was the price of an asset. P is the value of the portfolio. It's minus 1 over P, delta Y, where delta Y is exactly this shift I am assuming or that I observe, okay? Now, what we know is that our portfolio is made of a certain number of assets, okay? And it's not difficult to see that if there is a variation in the total value of the portfolio, this variation can be disaggregated, can be split into the valuations of the different assets composing the portfolio. I'm not saying that necessarily all assets need to change. For some assets, maybe the change is 0. But still, if I sum something plus 0, I can do that, and I can always write the change in the portfolio as the sum of the changes in the assets. So what I can do, I can apply the duration definition again, and what I have is that D is now equal to minus 1 over P, the sum of the sensitivities of the different assets with respect to the change in the yield. Okay, what I'm doing is just substituting delta P in this formula and collecting the terms. Okay, nothing more, nothing less. But now what is interesting here is that I can play a little bit with these quantities. I can collect these quantities as I prefer. And what I can immediately observe is that if I come back to the original definition of duration that we gave, if x is the value of the single asset instead of the s we were using before, if I consider minus 1 over xi, which is asset I, times delta xi, delta y, this is the duration of the ith asset. But that means that if I take these inside and I rearrange these terms, I can say that the duration of my portfolio is nothing more than the weighted average of the durations of the assets. And what are the weights? The weights are nothing more than the importance of that asset over the total portfolio. So if I have a portfolio that is made by just two assets and they have the same importance in my portfolio, so the total value of the portfolio is 100, and the two assets are 50-50, essentially they have the same importance, and that will be just the average of the two durations. But if I have an asset that accounts for 70% of the portfolio and an asset that is 30% of the portfolio, the total duration will be 70% the duration of the first plus 30% the duration of the second. If I have n assets, it will be n assets. So the duration of the portfolio is just the sum, the weighted, sorry, not the sum, is the weighted average of all the durations of the portfolio. You see, it's computationally nice because you have this linear relation between the duration of the single assets and the duration of the portfolio. So it's very simple if you have just parallel shifts to play with duration. Now, what can we say about hedging when we play with interest rates and with duration? We will see more when we introduce market risk property, not property, but also the properties of market risk, that interest rates are a tricky object and needs to be dealt with carefully. And on interest rate themselves, you could really not build one course, but a series of courses, because it's a rather complicated object. But you can imagine that if I build a portfolio and I intervene on the portfolio in a way such that duration is 0, essentially I'm building a portfolio that is immune to small changes in the interest rates, in the yields. And if I build a portfolio that also has a convexity equal to 0, it means that I will have a portfolio that is somehow immune over a short time horizon, because then there is dynamic hedging. So I will have to do that over and over again. It's not like the hedge and forget property of delta. So I will have to do that again. But if I make a portfolio that is duration and convexity equal to 0, my portfolio in a specific time horizon will be somehow immune to small and large shifts in the yields. Now the question is, if I want to make duration in a portfolio equal to 0 and I have a positive duration, it means that somehow I need to be able to generate a negative duration to compensate. If I have a quantity that is positive and I want to set it equal to 0, I need to remove something. So I need a negative duration. Now, negative duration is essentially something that we have already considered implicitly. As I was telling you before, in every transaction, there are two parts. If I buy a bond, there is someone getting the money and someone paying the money. I get the money because I'm buying the bonds and I get the money from the coupons and blah, blah, blah. But there is also someone that is paying the coupons, the issuer of the bond. If you are the issuer of a bond, you have a negative duration. Because you are not getting money, you are paying money. So for you, the transaction is negative. Your coupon here will not be 2.5. It would be minus 2.5 because you are paying. Okay? So duration will become a negative quantity. So essentially, when we speak about making a portfolio, building a portfolio with a duration equal to 0, we are not speaking about us. We are speaking, for example, about a large bank or a large company. You can do that by, for example, issuing a bond, going short on a bond, in a sense that you don't issue the bond, but still you go short on the bond, so you can build that, and this is something that we can also do ourselves. You can always go, if they trust you, short on an asset, and the duration strategy is nothing more than playing with the duration in a way in which your portfolio becomes decently robust to changes in the interest rates. Most of the time is just duration. No, you don't play with convexity, but there is no limit, so you can do whatever you want if you have the expertise and most of all the money and the trust to do what you want. Okay, so that was it, and see you tomorrow.